Good afternoon, investors. You are now on KleverStock with me, Dini, and I will be serving you the midday roundup with the latest market updates from this morning up until now. Opening today's market wrap with a look at the domestic front. Bursa Malaysia's benchmark FPM KLCI pulled back in early morning trading today as investors took profits following yesterday's strong 12-point surge. As of 9:08 a.m., the key index slipped 6.05 points to stand at 1,707.04. Market participants are adopting a cautious stance ahead of major U.S. market catalysts later this week, including the Federal Reserve upcoming interest rate decision and quarterly earnings results from global technology megacaps. The pullback was felt across key index heavyweights, with MISC dropping 9 cents to 8 ringgit and 3 cents, CIMB Group falling 8 cents to 7 ringgit and 72 cents, Tenaga Nasional shedding 8 cents to 14 ringgit and 38 cents, and Petronas Chemicals losing 10 cents to 4 ringgit and 65 cents. In research notes released this morning, Apex Securities expects the benchmark index to maintain a general rebound trend this week, supported by improved global risk appetite following de-escalation between the US and Iran. That geopolitical shift triggered an overnight plunge in Brent crude futures of nearly 9% down to $88.46 per barrel. However, analysts caution that local energy stocks may remain under pressure due to falling crude prices, while technology sentiment could stay selective following overnight weakness in US semiconductor counters. Among actively traded counters at the opening bell, SNS Network edged up 0.5 cent to 56.5 cent, TWL gained 0.5 cent to 2.5 cent, while Zetrix AI shed 1 cent to 67.5 cent. Moving on to our local currency and foreign exchange. The Malaysian ringgit opened on a mixed note this morning, strengthening against a basket of major currencies while easing slightly against the US dollar. As of 8 a.m., the local note traded at 4.0850 or 4.0900 against the greenback, down from Monday's close of 4.0835 or 4.0875. Market sentiment surrounding the US dollar remains cautious due to lingering geopolitical uncertainties over US-Iran negotiations and investor focus on the upcoming US Federal Open Market Committee meeting taking place today and tomorrow. Bank Muamalat Malaysia Chief Economist Dr. Muhammad Afzal Nizam Abdul Rashid noted that expectations surrounding US monetary policy continue to lend underlying support to the greenback, keeping the ringgit-US dollar pair bound within a narrow trading range throughout today's session. Despite the slight dip against the greenback, the ringgit posted solid gains across major global currencies at the opening bell. It appreciated against the Japanese yen to 2.4940 or 2.4973 from 2.4969 or 2.4994, strengthened against the euro to 4.6438 or 4.6496 from 4.6536 or 4.6581, and it rose against the British pound to 5.4281 or 5.4348 from 5.4433 or 5.4486. Among regional peers, the ringgit delivered a mixed performance. It gained ground against both the Singapore dollar at 3.1627 or 3.1669 and the Thai baht at 12.1379 or 12.1589, while edging slightly lower against the Indonesian rupiah to 226.8 or 227.2 and holding flat against the Philippine peso at 6.62 or 6.63. Now for some economic news. Private healthcare affordability in Malaysia remains constrained by the country's high reliance on direct out-of-pocket payments and relatively low social insurance coverage. However, CIMB research maintains an overweight stance on the domestic private healthcare sector, citing moderate procedure pricing and strong demand metrics. According to a report by CIMB Research, Malaysian private hospitals offer relatively competitive procedure fees compared to regional peers in Singapore, Thailand, and Indonesia when benchmarked against local median wage levels and purchasing power. This pricing structure has been further supported by the Health Ministry's Hospital Services Outsourcing Program, which transfers selected public hospital procedures to private operators to relieve public sector congestion. The research house noted that because consultation fees remain regulated under the Private Healthcare Facilities and Services Act, overall treatment affordability stays manageable even as medical inflation and restricted reimbursement coverage push out-of-pocket expenditure higher than in countries with comprehensive national social health systems. Among listed players, CIMB Research identifies KPJ Healthcare Berhad as a primary beneficiary due to its position as Malaysia's largest private operator by bed capacity. KPJ's extensive network across urban and rural markets, combined with its active participation in government outsourcing initiatives, positions it as a key provider for accessible care. CIMB Research has maintained a buy call on KPJ Healthcare with a target price of RM4.09 per share. The research house also reiterated its buy call on dual-listed giant IHH Healthcare Berhad with a target price of RM10.30, while keeping a hold rating on Sunway Healthcare Holdings Berhad with a target price of RM1.88 per share. We will now take a short break, but don't go away. We will return shortly with corporate news developments. Welcome back to the Midday Roundup. Let's continue with some corporate updates. Hotel and resorts operator Magma Group Berhad is targeting a return to profitability in the 2026 financial year, anchoring its turnaround strategy on its flagship Wolo Hotel and Residences project in Mont Kiara, Kuala Lumpur. The boutique branded development carries an estimated gross development value of 850 million ringgit and is planned for its official launch at Dewan Philharmonic Petronas on July 31st. Magma has posted net losses continuously since the 2012 financial year, most recently recording a first quarter net loss of 7.3 million ringgit on revenue of 6.26 million ringgit due to higher staff costs and expenses related to corporate exercises. However, Group Managing Director and CEO Datuk Seri Thomas Liang expressed confidence that sales from the Mont Kiara project will help push the company back into the black before the end of the year. The group has secured its advertising permit and developer's license, with pre-launch marketing already generating expressions of interest for approximately 60% of the residential units. Magma is actively marketing the project internationally across London, Hong Kong, Taiwan, and Singapore, targeting high conversion rates by year-end. The 60-story mixed-use development will be built on a 2.26-acre site and will feature 378 service apartments, 98 service suites, and 63-room boutique hotels, retail spaces, and supporting amenities. Under the business model, Wolo will lease and manage the 90 services suites on behalf of investors to generate recurring rental income. The hotel component will be affiliated with Marriott Bonvoy's Design Hotels network, granting access to its global loyalty program for over 271 million members, while the residences hold endorsement from UK-based global branded residences. On the operational front, Magma appointed Grand Dynamic Builders, a subsidiary of GDB Holdings, as the main contractor under a 439.4 million ringgit construction deal. Magma's hotel operations contributed 6.26 million ringgit in total hospitality revenue in the first quarter, though the group remains in a net debt position with 85.2 million ringgit in borrowings against 7.5 million ringgit in cash as of March 31st. Magma shares last traded unchanged at 28 cents per share, giving the company a market valuation of 540.4 million ringgit. Up next, we have a commodity update. The crude palm oil price outlook for 2026 and 2027 is increasingly being shaped by the onset of a strong to a very strong El Nino event, which meteorologists expect to peak between October this year and January 2027. In its latest sector report, RHB Research maintained its CPO price assumptions at 4,400 ringgit per ton for 2026 and 4,300 ringgit for 2027, noting substantial upside risk for 2027 due to the delayed impact of severe weather on crop yields. Global weather agencies currently project a 97% probability of strong El Nino conditions developing over the coming months. According to historical data from the Malaysian Palm Oil Board, drought-induced stress typically reduces fresh fruit bunch yields by 10 to 14% in the first year, with an additional drop if dry conditions persist. MPOB anticipates this episode could mirror the severe 1997 to 1998 event, potentially reducing Malaysia's overall production by 2 to 4% year-on-year starting on the fourth quarter. Estates in Negeri Sembilan, Johor, Pahang and Sabah are projected to face the most significant yield pressures. Beyond weather conditions, analysts highlight that CPO pricing is becoming heavily policy-driven. Indonesia's B50 biodiesel mandate, which took effect in July, is expected to absorb 18 million tons of CPO annually, representing over 35% of Indonesia's total output and significantly tighten global availability. MPOB expects average CPO prices to hold firm between 4,300 ringgit and 4,500 ringgit per ton, with a strong downside support at the 4,000 ringgit level. Given the 12-month lag between weather disruptions and physical supply contractions, RHB Research anticipates a secondary price spike could materialize in 2027. As a result, this research house maintains an overweight rating on the plantation sector. Its top buy picks include SD Guthrie with a target price of 7 ringgit, Johor Plantations Group at 1 ringgit and 90 cent, Sarawak Oil Palms at 5 ringgit and 20 cent, IOI Corporation at 5 ringgit and 5 cent, Kuala Lumpur Kepong at 23 ringgit and Hapsang Plantations at 2 ringgit and 60 cent per share. Today's major corporate developments and deals across Malaysia. Destiny BHD's 70% owned subsidiary M Rail Techniques SDN BHD has received a 45.6 million ringgit contract from Malaysia's Rail Assets Manager to undertake Level 1 and Level 2 maintenance, repair and overhaul services for 13 Class 61 diesel multiple units train sets. SNS Network Technology BHD has secured a $298.7 million, about 1.2 billion ringgit contract, the largest in the group's history, to supply high-performance artificial intelligence servers to a Singapore-based customer for a data center in Malaysia. Amalus Holdings BHD's wholly owned subsidiary Amalus Corporation STN BHD has secured orders worth $3.7 million or 15.1 million ringgit from an undisclosed South Korean customer for test systems for the data center and AI market. Oriental Interest BHD has proposed to acquire the entire equity interest in Chin Hin Jitra STN BHD and CHJ Motor Holdings STN BHD for 280 million ringgit via a conditional share sale and purchase agreement with LLSB 1980 Holdings STN BHD. DXN Holdings BHD's planned capital expenditure for financial year 2027 is up to 500 million ringgit, aimed at expanding manufacturing capacity, developing plantation initiatives, and accelerating market developments in various countries. Skyworld Development BHD has launched its first overseas sales gallery and office in Xuan Hoa Ward, Ho Chi Minh City, Vietnam, marking the company's first permanent physical presence outside Malaysia. UEM Agenta BHD has been appointed as project management consultant for the Batang Lupa 1 bridge, Malaysia's longest river crossing bridge at 4.8 km. Lastly, Tenaga Nasional BHD and Pengurusan Air Selangor STN BHD have signed an electricity supply agreement and a cooling energy supply agreement under which TNB will supply high voltage electricity to the Sungai Rasa water treatment plant in Kuala Langat and provide district cooling services under a 20-year concession agreement. That's a wrap for Midday Roundup with me, Dini, on KleverStock. Thank you for choosing us investors. Stay tuned for our upcoming live stream programs.